Hey everyone, welcome back to the Daily Gold Podcast. Today we're chatting with returning guest Greg Weldon, CEO of Weldon Financial. You can find him at weldononline.com. In my opinion, Greg is really the top macro guy out there, macro analyst, I should say, who really does an excellent job of looking at the macro fundamentals and then balancing it out with technical analysis. And that's why I have him on today. Greg, very interesting. I mean, there's so many ways I could start out with this, but something that's been very interesting to me, what I've noticed is obviously in the last week or two, you have weaker dollar, weaker bonds, but of course, stocks are strong, and you would think gold, maybe it wouldn't be the best performer in that situation, but you wouldn't think that gold and silver would really fall on their faces. And we've seen that, and also, going back since the gold market made that peak at the end of the summer last year, I mean, one could potentially kind of make an argument for a decoupling there, more so in the shares, but also in the metals. I mean, these precious metals markets now are a fair distance off their highs, and since that point in time, we've seen a pretty good rally in the stock market. So, I mean, that's kind of my observations. What is your opinion on that? Can we take anything from that? What would the fundamentals tell us about that?
Well, you can take a lot from it for sure, but it may not be, related to the fundamentals. So let's talk about both of those things. First, let's take what we have and let's break it down. I mean, to me, you've had a rally in stocks relative to gold. Okay, it's a play that we actually believe works the other way on the longer term basis. But in the near term, post election, you kind of had this dynamic where fiscal cliff is still a little bit away, in terms of a timeline. We have this major uncertainty removed with the election. We're starting to get some sense of clarity. People felt a little more comfortable going back into stocks. Certainly the Fed move, exacerbated that dynamic. But what we've seen then, so to my point being that, people felt a little more comfortable post-election going back into stocks to some degree. You got some of that fear trade in terms of, what happens if this is really a tight race and we have this uncertainty beyond the election. That didn't happen. Take some of this thing out of gold. I think it's a short-term dynamic. And then when you start to look at what's happening in the near term, really post-Fed, okay, you didn't get the same bang for your buck that you would have expected, for the Fed to be sitting here telling us that, we're going to take our balance sheet to, $3.8 trillion by the end of next year. You would have thought that might have had a more positive impact, and it doesn't. Then you ask yourself, why doesn't it? Well, does that mean that the impact of Fed policy is now diminished? And that if so, this is a major, major problem going forward. I don't think that's the case. I think this then gets back to our near-term focus, back on the fiscal issues. You came out of, some of the early post-election negotiations on this with a real positive vibe. And I remember saying several weeks ago, if you think that the Republicans and Democrats, as far apart as they are in these key long-term issues, are going to agree, 6 to 8 weeks before their deadline, that is absurd. So, of course, we're going to take this down to the end. And now is it not only down to the end, it's like, okay, we're going to fracture this even further so that we can put a Band-Aid on a bleeding jugular and hope that somehow, miraculously, the blood stops flowing. And now markets today start to get a sense of, you see stocks down, dollar down, gold down, and you're kind of like, this doesn't make sense. If the dollar's going to break down here, maybe that should be bullish for gold. Well, I think it's, really this fiscal issue. You see kind of declines in all of these things, in tandem. You have strength in the euro currency, which is surprising given what's going on in Europe. If they're really going to have to come to the plate in terms of an ECB litmus test at some point. But they're doing nothing, and that's actually hardening the currency. So you also have that as an offset against the dollar. I think you need to take a major grain of salt in understanding there are some short-term dynamics here at play that may not be in the direction of the fundamentals. Now, to make a long answer short, having said all that, there's technical damage being done this week. That much is for sure. So it's going to be interesting to see how it plays out.
Greg, let's switch markets here and talk about the S&P, maybe emerging markets. The DAX looks like that made a new high today. We've seen a positive reaction to the Fed news in a lot of these conventional assets, you could call them. And, so you get all the strategists on TV, they're looking for their 10% gain next year. The economy is going to bump up a little bit, they say, because emerging markets are going to be stronger and, Europe will figure it out. They'll get a deal done, all that. And then you get the technical guys looking at the charts. They see the DAX break out, they see emerging markets are looking better. The S&P's rebounded. I mean, does this kind of just it feels a little bit to me, I should say, kind of like a last gasp type move in this cyclical bull market. I mean, it's really I don't think it's supported by an economy that's going to get much better. And I mean, we know that a lot of these bull markets, it takes a long time for them to end. I mean, the move at the end of summer in 2007 going into October, I mean, it was such a massively huge fake out, and then 3, 4, 5 months later the market was in such bad shape. I mean, what are your thoughts on that? Could this kind of be similar to what you're saying, where there's some short-term dynamics at play here, and people, although they have to respect the charts in some of these markets, they do have to kind of worry about maybe the technicals kind of diverging from the fundamentals here in the short term?
Well, I think they are right now. So, I mean, the technical negativity that we're seeing below the 200-day moving average in gold, for example, the positive technicals you've seen in the stock market, where you did have these breakouts. I mean, let's examine this from another standpoint. Let's kind of spin this all around and take a somewhat different perspective on it, just to put it out there, because that's what we do. We sit here and think about it. What if this is what's happening? What is it? So when you start to see things crystallize, you've kind of thought them out already. What if you're in a situation where what the markets are kind of suggesting here, and this is a bit of a reach, but I think it's interesting thought process, that we know, okay, that first of all, before I even go there, I have to preface it by saying you can break down stock market performance if you throw out the DAX, okay, as an outperformer in Europe that has drawn money in from the other countries. If you throw out the DAX, you can almost make a one-to-one correlation relationship not only between the central bank and the stock market, but the relative between Japan, China, U.S., and Europe. The Fed being most aggressive since the beginning of 2010 in terms of expanding their balance sheet, S&P is the best performer. You can knock it down all the way to, you look at Europe, which is kind of lagging now. Both the Bank of Japan and, surprise, surprise, the People's Bank of China have expanded their balance sheet more than the ECB has since the beginning of 2010. You're starting to see the Chinese stock market starting to rally. It's certainly not in the shape of DAXs, but if you compare it to Italy or Spain, it's a whole different picture. My point in saying all this is to take it to the next level. The Fed has told us they will continue to be that aggressive until the unemployment rate starts to come down. Well, we know conventional policy, is stuck in terms of trying to generate a decline in unemployment. Quantitative easing is not the answer. It's not going to work. There's not a direct relationship. You have to get the asset market so high that, you get jobs created through purely, reflation in equity values. That's going to take a lot more reflation. The Fed has just told us we will keep pumping until we see this at least through the middle of 2015. Well, what if all of a sudden bad economic data, particularly in the labor market, is now seen as bullish for asset prices, stocks in particular, because it means the Fed is going to keep pumping money in. And it's not really even bullish for gold. If we want to suggest, and I think it is bullish for gold, but what if there is some thought to be had where what they're not doing is by failing to stimulate the labor market, they're failing to generate income growth, and therefore they're failing to give us any kind of conduit to where real inflation is going to be a problem to where gold would outperform stocks. So I don't know. I don't think that's the case. I think it's straightforward. Fiscal cliff is near term. The asset purchases by the Fed will be long term, and longer term it's going to be bullish for both stocks and gold. I think, in your perspective, there's a day of reckoning out there for stocks. Absolutely, because the real economy will not respond, and at some point that will matter. So does that mean it's the end, middle of 2015? I don't think we get away with it for that long, but it doesn't mean that 2013 has to be a horrific year for the stock market either, with the Fed pumping, $90 billion a month into the asset markets.
For me, I just can't see how gold can, assuming it's going to have this next, whenever it comes, obviously, given the technical damage, we know that a break to new highs is going to be far off. It's not realistic, definitely, in the next couple months. But I just don't see how we see gold outperform with the S&P still holding up okay. I mean, I think I think the divergence that we're seeing kind of portends to that at some point in the future. Not saying it's going to happen in the next couple of months or so, but it would. I just feel like with gold, if you're getting later in this bull market, you get a big move over 2,000. I think you're going to see money move out of stocks. I can't see how gold and S&P can
I agree with you.
Continue to go up all at the same time. So as a gold bull and as a gold bug, I don't like what's happening right now. But at the same time, I feel it's a good thing because we're seeing the divergence. We're seeing these other, with the exception of today, we've seen these other conventional markets perform well. And when they perform well, the average advisor is going to, right now, they're all saying gold is done. They don't care. I even saw one economist that got sent to my inbox that said gold's not going to go up because the dollar is going to be strong because the other countries are printing more money. I mean, that's the kind of lunacy that we're seeing in the mainstream camp. And so they're all done with gold. And I think we still need to shake some gold bugs out here because they have been too optimistic, probably myself included. But sorry, Greg, I know I'm dragging on here, but...
No, but I mean, what you say is absolutely true. I mean, that's a faulty assessment by whoever says that other central banks are creating money more quickly than the Fed. That is simply not true. There has been a period of time where the Fed has been dormant, no doubt about it. But if you go back to the beginning of 2010, you go back to when the Fed unwound the selling of treasuries that they did in the initial phases of the crisis to finance TARP and TALF, they actually sold $300 billion in treasuries. QE1 really bought that that amount of treasuries back. So if you go back to really QE2 and you look at it, there is no doubt that the Fed has been the most aggressive, and that this has had an impact on the stock market relative to other stock markets. Even we have said though, I mean, we have preferred gold in yen. I mean, the Bank of Japan has started to play catch up. The Bank of Japan has been more aggressive. They've expanded their asset purchase program 3, if not 4 times this year. And they have a lot more to do, and they're becoming more creative by buying REITs and now talking about, directly investing in the stock market, buying ETFs, and doling out money to hedge funds. Okay? This is the latest BOJ proposal. They meet tonight, or did they meet last night? I actually was traveling today. So, I don't know if they actually had announced that, but that would be most interesting if that were part of their next decision, because they've been very aggressive. So, watching gold in yen, first of all, and then second of all, gold in renminbi, because while China has expanded their balance sheet, they haven't cut official rates aggressively, not to the degree that the inflation has fallen, and therefore real rates have risen in China. It's been one of the reasons their currency made a new high against the U.S. dollar, a new post delinking high. Chinese renminbi just recently. Didn't hear much about this in the press. Gold in renminbi was being pressed and kind of broke down, and now gold and dollar is bidding to follow. So I think that's problematic. So we're very closely watching gold and Japanese yen right now in terms of trying to determine this near-term path. On a long-term basis, though, I agree with you. Longer term, one of my favorite trades is gold, being long gold against the S&P. I mean, it just is.
That has gone down. I was just looking at it a moment ago. That chart hasn't made a new low for the year. So we'll have to see how that holds up. But getting back to the next catalyst for gold, is it really going to be is it possibly the next QE or policy? And I don't want to make that simplistic. What I'm saying is they've already announced what they've announced. Let's say over the next couple of months the markets get weaker, some bad data points come in. I mean, is it something like that kind of has to bring about more forceful action, a real second round to kind of stimulate gold and get gold to act as it should?
I think that the focus for me right now, I mean, the fiscal issue in the U.S. obviously is clearly a focus, but I think that will be over sooner rather than later, at least in terms of giving clarity. Not that the problems are going to be over, that's for sure, but you'll have clarity as to what the math might look like on a short-term basis. So that shifts the focus early first quarter for me directly to Europe, because I mean Europe still is problematic. The fact that we're going to derive positives out of pushing back Greece for a third year in a row, I don't see how that's at all positive. I think there's still some significant issues to be had there, economically as well. Now that you see a downturn in some of the numbers in Germany, in particular. So I really am kind of focused on that. And what's interesting is the euro currency is actually strengthening. It's strengthening because they're not monetizing debt, they're not debasing their currency, they're not doing what the U.S. is doing. And while that may be problematic down the road, right now it's not. You're at yield levels that seem to give us a status quo. I watched in particular, the 5-year Spanish bond yield, 7-year Spanish bond yield. That captures the average duration of Spain's debt. So that's a key interest rate for me to watch. And right now, the ECB has done a phenomenal job without having to do anything in keeping those rates where they kind of need to be to prevent a complete implosion. I don't think they're going to necessarily get away with this without having to be forced to do something at some point in the first quarter. Now, does that mean you have to have a break in gold and some kind of problem developing, in terms of the euro going up, which puts even more pressure on the economy? How does the ECB deal with that? They don't have a lot of conventional policy tools left either. So this is becoming increasingly more intense as we go forward in terms of these countries competing with one another, to try and debase their currencies to some degree. Right now, European currencies breaking out against a lot of currencies. Look at euro against the Canadian dollar today, for example. Big breakout. I think this is interesting, but I also think it sets up, the next stage of problems. And then how does the ECB deal with that? And then what does that mean for gold?
And Greg, can you talk about how much debt that the U.S. and others have to roll over in the next, I should just say 2013, because I know they took on so much debt 2008, 2009. Is this going to be a big year, a potential big problem for them having to roll over this debt, or is it? Do you expect that to get bigger, maybe 2014 or 2015? Is this something we should worry about as a potential catalyst for the metals or not?
Absolutely. I mean, because it's a catalyst for central banks, and that's the bottom line. And this is the whole argument, in a nutshell, from the ground up. And yes, 2013 is by far the largest, debt obligation schedule that we have in front of us. That's not to say that 2014, 15, 16, all the way out to 2040 are not large. They're not as large as 2013, not yet anyway, depending on, what degree of, rolling and shorter-term maturities we might see by individual countries. That applies not only to the U.S., it applies also to Europe. It applies even in a greater proportion to Japan. And it applies to countries you might not even consider, like Canada, who has a significant amount of debt due in 2013 and doesn't have a lot of debt in total. It's like, I just from having looked at the numbers, I don't want to throw out facts, but I mean, it's close to half of their debt is due in the next 12 months. In Japan, the numbers are huge. I mean, so to me, Japan is a big, was a big issue coming into this year, will be a big issue going into next year. The BOJ has really started to push. You see the yen breaking down. That's been one of our favorite trades, and it continues to be, and certainly in the U.S. But again, it comes back to kind of looking at Europe. And when I look at Europe, I don't just focus solely on places like Spain and Italy. I look at France. I see major potential problems with France and Belgium. When you talk about the debt and you start to make some comparisons, all right, Belgium's debt doesn't look real big and their interest rates are really low, and they always seem to get this kind of this common courtesy as a core country, as a safe haven play. They're not, and I watch them very closely. Their debt relative to their population is larger than Italy's and almost as large as the U.S. So, you have places, landmines out there that you don't always consider, a place like Canada, a place like Belgium, where debt is huge because right now, looking out at 2013, debt maturing is huge everywhere. And in a lot of places, the new debt's going to be big, and that's particularly true in the U.S., because I don't care what these politicians decide. Public borrowing is going up. It's going to be above $1 trillion for the third year in a row, and that's all new debt that has to be sold. You have a lot of countries in that position. And, Jordan, you have a bit of a pull away to some degree by buyers. The Fed has returned. Okay, the ECB's not there as a buyer right now. China hasn't really been active at all. In fact, they've been sellers of U.S. Treasury debt over the last 6 months cumulatively. You see custody holdings continue to rise. So it's a central bank game. banks in the U.S. are sitting on $2 trillion of bonds already. They're really not likely to buy a ton more. The public has, bought a ton of bonds and then shifted some of their money out of bonds back into stocks over the last 9 months. In terms of one of the biggest onslaughts of supply, you also have issues with the potential degree of buyers that you have out there, particularly if central banks shy away. It puts a lot of pressure on central banks to buy more, to monetize more, to continue to push a monetary policy, and at the end of the day, longer term, that's bullish for gold.
Now, Greg, before we finish here, let's kind of fuse together, macro technicals and also sentiment, maybe with a little focus on sentiment. I mean, I don't want to ask another leading question here as I've done before, but I mean, in my opinion, it sounds like there's some real potential, extremely positive catalyst for precious metals. Yet at the same time, as you have to balance that against how everyone's positioned and, what the charts are saying. And, I'm looking at the gold chart here in front of me, and you could also say the same thing about GDX and the stocks. They do have pretty strong bottoms, and, it looks like they're going to retest those. I mean, provided, let's say, we make a higher low in both cases, even though it's a slightly higher low, maybe in the next month or whatever, and we get some better technical action there. I mean, it just seems to me if that happens, that would really kind of mark a strong contrarian opportunity where you don't have the broken support, yet you're close enough to the bottom that you're trading off the highs, and at the same time focusing on these fundamentals, as you just eloquently explained. I mean, it sounds to me, piecing it all together, there is potential for, I guess, some explosive catalysts in the coming year.
I mean, you're in a technical zone here where you do have a setup, for a potential ABC pattern into a, Fibonacci retracement. We've discussed this, off the air, so to speak. 1629 is your next key level. You've taken out 1672 in gold. You've taken out the 200-day and the 52-week moving averages, and you're right on the 50% retracement of the move from the low at 15 and a quarter, to almost 1800. So you do have the setup technically, while it, is it's damaging here, the price action technically. It still has, holds out hope for being corrective in nature. And also, let's not forget, when gold was between 1575 and 15 and a quarter, from, roughly September, October of last year through whatever it was, June, July, into August of this year, central bank buying was significant. And, one of the largest quarters ever, in fact, in the second quarter this year, May, June, July, when gold was in that zone, in the 1575 to 1550 zone particularly. So a lot of candlestick chart days where there was huge tails, meaning you were much lower, you down big on the day, and then huge reversals to the upside on big volume buying. So central banks, let's not forget, they have a vested interest here too. They don't want to see gold break down. They may not want to see it take off, but they also, most assuredly in my mind, do not want to see it break down. It would be a signal of failure of their policies. It would expose the underlying real macroeconomy as, for what it is, which is still broken and not providing any impetus for any kind of wealth reflation or wage/income reflation. So I think there's a lot to be said for all of that. And when you talk about the psychology and the positioning, you don't have speculators are not really long here. You get some big-time headline, ETF buyers, hedge fund guys for sure, smart guys. They're long-term players. They're buying. I mean, that tells you something right there. But you don't have a speculative fervor for sure. You didn't when you got to 1800 here. It wasn't like the CFTC Commitment of Traders showed, huge long positions in the futures markets. It didn't. So I think you have a lot of dry firewood on the sidelines that can be thrown on a fire, if central banks do come in here, particularly the ECB, or if in the case of the U.S., you get the fiscal issue out of the way and people realize the Fed is pumping pretty hard, not as hard as QE2. So, I mean, if you want to just spin this real quick at the end here and talk about, where's the risk? The risk is that, central banks don't monetize quickly enough, find themselves in another debt issue, 6-9 months from now, and it's, real bad negative economic news. Central banks are not pumping, and, everything's going down. So there is risk that there's a policy error to be had here. But I think the Fed in particular has shown leadership here, and the most recent decision, right in the middle of this fiscal issue, really speaks volumes, as most of their moves have, to the degree that a willingness to be very aggressive in buying debt and trying to debase the currency. So I think all those things are very positive for gold, from psychological, fundamental, central bank. But that's, again, not to say there's not risk to all of that either.
Okay, Greg, before we close, why don't you tell our listeners how they can subscribe to your service?
Thanks, John. Yeah, it's great. We offer anyone who's listening a free 30-day trial to our research products, of which there are 3 specifically. The Money Monitor is a global macro, talks about all of what we've just talked about and more. Chinese trade, Japan, Europe, anything and everywhere, emerging markets. And we also have a product called Trade Lab that is linked to the Money Monitor, which gives specific trading ideas. Some of the trades we've had on recently, short the yen has been a very good trade. Recently bought the Aussie stock market. Just in terms of specific trades, futures markets, ETFs, currencies, commodities, and bond and stock indexes. So it pretty much covers a broad spectrum of markets for traders and individual investors. And then we also do the Metal Monitor, which is our gold and silver specific product that is an audiovisual research product. And we do run a CTA. We have 3 different types of managed account programs in the futures and commodity markets. So it's weldononline.com. You can get information on all of that.
All right, Greg. Well, thanks so much for joining us today on short notice. I really, really appreciate it, as do my listeners. And I imagine we'll be in touch in the new year. Happy holidays.
My pleasure, Jordan. Yeah, have a great holiday.
Okay, thanks, Greg.